Okay, hi all. Here we are going to discuss some parts of the session, evaluation of long-term finance sources. Under that, we have to discuss two categories as cost of capital and valuation of securities and bonds. Here, in this session, I am going to discuss about the cost of capital. Here, at the end of this session, I hope you may be able to define the concept of cost of capital and WACC, identify the different types of sources of finance, calculate the cost of capitals of each source, calculate WACC, rationally making decisions about the sources of finance based on WACC or cost of capital of each source. At end of the day, that means end of you refer this video session, you just check whether you are having capacity to do this. Okay, now let's see the term cost of capital. I hope in the previous session you may study the basic structure of the financial management. In that, I believe that you have studied that in economical world, there are two parties, people who are having surpluses and people who are facing to lack of funds problem. In this scenario, what is actually happening, you may study that through the financial market, the surplus, the parties who are having surpluses of funds may give funds to the parties facing the problem of lack of funds. Then, behalf of that, these parties have to pay interest, dividend, or something for the parties who actually invested. This is the fundamental circle. In here, let's say one person is having surplus of funds and one person, there is the institute, business firm, okay, there is a business firm who expected funds to run further their businesses. Then, let's say this person is A. A can invest their additional, that means surplus funds in this business. Let's go business as B. B as ordinary share purchasing, preference share purchasing, debenture purchasing, as like that. Let's say he is purchasing or ordinary shares, then the business can use that fund. Okay, this is some complex scenario I am explaining in simple manner. Then business can use that fund for running their business. Then after earning profits, then business have to give something from their profits for A. A is investing for ordinary shares by expecting that return, that is known as expected return. So when it's become ordinary shares, B should pay dividends It's a return for A, but it's a cost for B. So, but if B needed to gain funds from A to run their business activities properly, B should incur that cost. That is known as our concept, cost of capital. So this can be happen in various ways. Let's say B can obtain a loan from a bank. Then at that scenario, B is having to pay interest. Or otherwise, A can purchase preference shares of this particular business B. At that scenario, B has to pay dividends for preference shares. Or it can be a debenture. At that scenario, B has to pay interest, that means business. So that is the simple meaning of cost of capital. Please go through the content of this presentation slide. Cost of capital. The return the firm's investors could expect to earn if they invested in securities with comparable degrees of risk. In here, let's say A is investing ₹1,000. Hope you know about the ordinary share concept. In that scenario, if B earn profits only, they may have to pay dividends for A. But if A put this ₹1,000 as a serving in a bank, what will happen? Definitely, they may earn interest on that saving. සරලයි බැංකුවේ දැම්මොත් එහෙම ඒ ගානට පොලිය හම්බෙනවා. ඕඩිනරි ෂෙයාර් වල ඉන්වෙස්ට් කරොත් එහෙම ඒ ගානට ලාභාංශ ලැබෙයිද නැද්ද දන්නේ නැහැ. It depends on B's profitability and B's future activity. That is. Then why A is going to invest on B by ignoring put it as a serving in a bank? The reason is high expected return. Why A is expecting higher expected return to the investment is riskiness is high. So when we consider the concept of the expected return, there is a positive relationship between risk and the expected return. I have put here, there is a positive relationship. Okay, that's why some people are investing risky sources like ordinary shares, sometimes like pyramid or something, because riskiness is high. Then at that scenario, they are expecting high return. As riskiness is high, the probability of missing that is also high. Okay, so you may study these things in future. The cost of that a company has to pay as dividends, interest, etc. in obtaining capital from the sources like ordinary shares, preference shares, or debentures are the cost of capital, the thing which I explained. Then, when it's become an organization, let's say a company may have to found a funds, let's say ₹100 for the running their businesses, at that scenario, they may not depend on one particular source. They may obtain some part from the ordinary shares, they may obtain some part from the preference shares, they may obtain some part from the debentures. Then directors of particular organizations or simply the top level management have to decide the portion of their capital structure, portion which should be consist as ordinary shares, portion which should be consist as the preference share, on the other hand, portion which should be consist as the debentures as etc. That belongs to the management. Based on these scenarios, cost of capital, WACC, external environment factors, riskiness, as like that. Based on that, they may decide. Then capital structure, you may study these concepts further, can be defined as firm's mix of long-term financing and equity finance mix, how they have obtained required funds. Then here, I have put in this slide some long-term sources of capital. Here, you can see we may have in debts, we may have in preference stocks, common stock. Common stock we can divide basically into two categories as ordinary shares and retained earnings. Retained earnings, I hope that in accounts you may study this concept. Okay, when it's become long-term debt, cost of capital is interest. We have to pay interest for our debts. When it's become preferred stock, we have to pay, organizations have to pay dividends. When it's become ordinary shares, organizations have to pay dividends. In here, the concept of weighted average cost of capital, this is the fundamental purpose of this. Actually, at the end of the day, this is what you are going to calculate. But here, I will explain the concept. This, let's just go through this weighted average cost of capital. It's known as WACC abbreviation. This is the cost of capital for the firm as whole, and it can be interpreted as required rate of return on the overall firm. Firm will normally raise capital in variety of forms, and that these different forms of capital may have different costs associated with them. Let's say, as an example, let's say a firm's requirement of capital is rupees 100,000. අපි හිතමු ව්‍යාපාර කටයුතු කරගෙන යන්න රුපියල් ලක්ෂයක් ඕනේ. They may found this required capital, they may fulfill this required capital through, let's say, through ordinary shares, rupees, let's say, 70,000 LKR, through preference shares, let's say 20,000 LKR, then debt, debenture, let's say, 10,000. We may study ways of we need to follow up in case of calculating the cost of capital for each of these source. But now let's assume that for ordinary shares we have to pay dividends of 10%. No, 20%. For preference shares, 15%. For debt, let's say 10%. Okay. එතකොට සාමාන්‍ය කොටස් වලට 10%ක ප්‍රාග්ධනයේ පිළිවෙලක් කරනවා 20%ක වර්ණීය කොටස් වලට 15%ක සහ ණය කර සඳහා 10%ක 20%, 15%, 10%. Here this is the basic equation which we followed up in case of calculating WACC. Here the W means here one W available, here one W available, WD, WP, WC. Okay, let's say here W refers firm capital structure weight. That means in here, let's say first W belongs to KD means cost of debt. First W means here total WD. Total capital is 100,000. Then from that we are having debt capital 10,000. Then 10% is the weight belongs to debt. I hope that you have get the idea of this weight. Then WP preference share. Total capital requirement 100,000. From that 100,000, this particular business is having 20,000 of preference shares. That means %. Yes, 20%. Here, 10%. Then, when it's become ordinary shares, let's say that as the WS, total capital 100,000. Then from that, ordinary share capital 70,000. That means 70%. That is the weight belongs to the ordinary share. Then how to just forget, just let's say we are not going to pay taxes here. Okay, I will come to that point. Then for this, in case of discussing the basic concept, let's say in this scenario, in this particular scenario, we can calculate the WACC. Weight belongs to debt is 10% into cost of debt. It has been given here 10%. Cost of debt 10%. Plus, or otherwise if it is difficult you can put the by decimal too. Then weight belongs to the preference shares. Here we identified that as 20% into cost belongs to the preference shares has been given 15%. Then plus I will put in here plus weight belongs to the ordinary share is 20% into cost of ordinary share capital also 20%. Oh, sorry, here 70%. Then final answer of this is firm's weighted average cost of capital, or otherwise overall cost of capital. I think now you are having an idea of calculating weighted average cost of capital. Now, what we need to do is we have to study how to calculate cost of this ordinary share, how to calculate cost of preference share capital, how to calculate cost of debentures. Then by calculating each cost belongs to particular source, we can come to the concept of weighted average cost of capital. Then we can follow up the way which followed in here in this particular scenario. Then we can calculate weighted average cost of capital. When it becomes past papers, I think in most cases around 15 marks, 15 to 20 marks come from this area. Okay, now let's see how to calculate different sources of finance. What belongs to different sources of finance? Okay, first we move to cost of ordinary shares. Then that means cost belongs to here AS. Okay. There are three models in your case you have to study. One is dividend valuation model. Next one is dividend growth model and capital assets pricing model. Then when it becomes capital assets pricing model, you are going to study that one deeply in under the next semester, the strategic financial management also. Anyway, in this semester, you should have some knowledge that of that also. Let's see. Okay, now let's see how to calculate cost of ordinary shares in using these different methods. First, let's see dividend valuation model. Just read. When it's become different valuation model, it is assumed that market price of shares, keep in mind, not the cost, market price of shares will be determined by the future dividends of such shares. Therefore, it is considered that present value of future dividends is equal to the current market price. That means if we assume market price of a ordinary share as P0, okay, according to the dividend valuation model, market price equals to the present value of future dividends. Let's say in year 1, after 1 year, that means in 0, now we are purchasing a ordinary share. Okay, then after 1 year we are going to have a dividend. Okay, then we have to get the present value of all the dividends which are going to receive. Here, when it's become D1, we can have the present value. We can calculate present value by discounting. I think you have studied the way of calculating present values. Here I am not going to discuss the way of calculating the present values. Here, dividend divided by 1 plus R. Then in second year also we may have a dividend. Then D, here D1, here D2, equals 1 plus R. That means after 2 years, power 2. Then third year also we may have a dividend T3 1 plus R power 3 as like this. Then let's say in end year after certain period, we may having a dividend, let's say dn divided by 1 plus r n. Here students, keep in mind, in dividend valuation model, we have to use some assumptions. Here I have mentioned those. One is no tax payments. Next one is dividend ratio is not changed due to the infinite. That means here D1, D2, D3, Dn all are same. It's not going to change. No retaining. That means firm will distribute all the profits belong to the ordinary shares. No surpluses called retained earnings may hold within the organization. So, based on those assumptions, we can say, as we are following these assumptions, we can come to a conclusion like this. Then simple equation for the market value in next session we may discuss. So in my case, my next session, I may discuss the valuation of bonds and securities. At there we may discuss this concept deeply. Then we can develop simple equation based on these assumptions. P0, that means market value of ordinary share, equals D, that means their dividend, which is not going to change, divided by RE. RE, here RE is the cost of capital. So here what we are going to calculate is RE. Then we can subject highlighted the RE from this particular equation. Then we can develop a simple equation for RE. RE equals to D divided by P0. Then when it becomes dividend valuation model, a simple equation of this, which I show the way of developing that equation, can be used to calculate the cost of ordinary shares. What is that? RE, here RE refers to the, here RE refers to the cost of ordinary share. Then here D refers to the dividend, and when it's become dividend, keep in mind dividend ratio is not going to change. Here P0 is market value of an ordinary share. Okay, hope you got that, I think. Okay. Now let's see some examples. Example number 1 in here. Just read it and let's try to do this one. Here, the current market price of an ordinary share of ABC company is rupees 50. A dividend of rupees per share has paid by the company. Calculate the cost of capital of an ordinary share. Here OS means ordinary share. Simply in here we can use this method, that means dividend valuation model. Here already we are having the equation RE equals B over B0. Then here we are going to calculate the RE. Dividend has been given 6 rupees. Then rupees 6 divided by market value also have been given rupees 50. Then cost of capital we can get as a percentage. Cost of ordinary share 12%. Okay. Then students, keep in mind, when it's come to the concept of market price, okay, it can be given, it can be expressed in two ways. Normally we know those as, put that note, market price can be given as, let's say it as cum due and or ex due. Okay, here cum due means, no, here cum due means market price consists the value of dividend also. Ex due means the scenario like example 1, market price is not including a dividend value. That's a simple meaning. You have to refer something in here. In case of here, you have to refer more as it is student-centered learning. Okay, I just give the idea. Okay, let's come to the example number 2. In example number 1, that means that which we did in earlier, some which we did in earlier. If the current price of ordinary share is determined at cum due price, that means it includes the dividend value too. Calculate the cost of ordinary share. Dear students, in that particular scenarios, we have to follow up this equation. RE equals to D divided by, here as this P0 which has been given in the sum consists the value of dividend. From here we have to deduct this dividend value. Then in case of here, dividend value is rupees 6, P0 is rupees 50 minus dividend rupees 6, then final answer you can get around 13%64. So please do these sums again and again. Identify the rationale behind these sums. Okay, then only you can identify these theories in comprehensive way. Okay, now I think that part is enough for us. Now I will move to the next method of calculating cost of ordinary share capital, that is dividend growth model. In here, in earlier, we assumed that, that means under the dividend valuation model, we assumed that dividend ratio is not going to change, but here the concept is little bit different. Here we are assuming that dividends are increased annually in constant rate. Okay, that means let's say in case of first year we have received D. Okay, I use the color. In first year we have received D. Then in second year we may receive D into 1 plus G. G is the rate, that constant rate which is going to increase annually in the dividends. Then in second year, this one, third year, what should be? It should be D 1 plus G. This is what we received in previous year. Again it is going to increase 1 plus from 1 plus. Then in third year, D 1 plus G 1 plus G 1 plus G. So in simple manner, we can write this. How? This one we can write D 1 plus G power 2. Here D 1 plus G power 3. When it becomes n, infinitely, up to infinite this is going to happen. Then for n we can have one D n 1 plus G n. Okay, hope you have got the idea. Okay. Based on this, we can develop an equation for the market value. Here, dear students, as we discussed in the previous method, under dividend valuation method, market price of ordinary share is equal to the present value of the future dividend. That concept may be value for in here also, in dividend growth model also. But earlier that dividend rate is not going to change. But when it's become dividend growth model, dividend is going to increase at a constant rate annually. Okay, then market price, you may discuss this one in deep manner. We can have a equation for market price as P0 equals to D0 1 plus G divided by RE minus G. Here, what we are going to discuss in this particular slide is cost of the ordinary share capital. That means from this equation, we can identify the RE, then we can develop an equation for RE, then RE equals to D0 1 plus D divided by P0 plus G. Same equation I have put in this slide. Here it is simple. D0 1 plus G means we can put it as D1. What we are going to have in year 1, as like we did here, D0 1 plus G. Then keep in mind the simple equation Ks, here in the slide it is available. Ks, cost of equity, ORE, OKS, Ks, cost of equity equals to D1 divided by P0 plus G. Okay, here this equation should be like this. Okay, the slide should change little bit. D1 divided by D0 plus G. Please keep in mind. So that's all. Okay. Then example number 3. Let's see. If D0 equals to 4, P0 equals to 50, G equals to 5%, what is the cost of common equity based upon the DCF approach, dividend growth model? Okay, then already we have discussed the equation in previous sum. Here you can see. Then what is that? Cost of ordinary share capital equals to D1 divided by P0 plus D. Here we have to identify the D1, then D1, how to calculate? D1 equals to D0 1 plus D0 with within bracket 1 plus D. Then here D0 has been given rupees 4, 1 plus G has been given 5%, 0.05. Okay, you can get the answer, or otherwise you can simply substitute this one on behalf of D1. Then D1 equals to 4 within bracket 1 plus 0.05, okay, divided by P0 is 50 rupees plus G has been given 0.05. Okay, then you can get the answer. I am not going to take the answer. You can get the answer now. Then here the concept of growth or G, actually the G here, assuming that it's going to be constant, but there are some methods, basically two methods to calculate this G. In some cases, in previous year past papers also, you have to calculate G. G is not giving, you have to calculate. There are basically two methods to calculate G. One is RB model and one is, let's see, I will do calculating G. Okay, when calculating G, you may have to use, you can use two methods. I will show you. One is based on previous year's dividends. Another one is based on, there is a model called RB model. Okay, calculating G. Here In example number 4, we are going to use, as we are having given, dividends belongs to previous 5 years. Here we are going to use this first method. That means here we are going to calculate the growth rate based on the previous year's dividends. Okay, let's see. Records related to the dividends paid over last 5 years of XYZ company is as follows. 2015 total dividends, not per share. Okay, here they have been given total dividends. In 2015, 150,000, then in 2016, 17, 18, 19, we have been given. And under additional information, it has mentioned 10,000 shares has been issued. Current market price of a share is rupees 75. Then they are asking calculate the ordinary shares, but here before that we have to calculate G. Okay, let's calculate G based on this information. Okay, well, let's calculate first the G, then we can calculate cost of ordinary shares using dividend growth model. Yes, students, keep this equation. G can be calculated as G equals maximum dividend which we received in recent given years, that means here 5 years or 4, divided by minimum dividend, here N. In here, maximum dividend which we have received is 260. Okay. Minimum dividend belongs to this details is 150. The number of years is another matter. If we assume that, let's assume these dividends are paid end of year. If the scenario like that we are having, based on this assumption, if we assume that these dividends are received in the end of each year, then we may receive the first dividend at the end of 2015, then we cannot consider this year. And we may receive last one in 2019 end, then here 1 year, 2 year, 3 years, 4 years. Then number of years N. If we assume dividends are paid end of the year, okay, then we can substitute the values for the equation. Here one minus also should come. Then equation. Then let's substitute the information for this equation. Numbers of years for maximum dividend which we received is 260,000. Minimum dividend which we received is 150,000 minus 1. Then we can calculate the answer using the calculator. Be careful when you are doing calculation. It's around 0.1474. Please check this answer. Then we can say that 14 0.74%. This is only the G. Here we are going to calculate the cost of ordinary share capital. Okay. Here we are going to calculate cost of ordinary share capital. In dividend growth model, we can calculate cost of this ordinary share capital by using the equation which we discussed earlier. RE equals to D1 over P0 market value plus G. Okay, here market value has been given. Current market price of a share is 75. As 75 it has been given. Here D1. Here we have to identify, keep in mind students, these values are belong to the all ordinary shares. So we have to identify the dividend which paid in year 0. Today we are going to calculate. These are the previous year's information. That means D0 equals to the dividend which paid in 2019. But here we have been given total value belongs to the all ordinary shares. Total value is 260,000. D0 equals to 260,000. They have paid this 260,000 for 10,000 share. Then per share value we can get per share dividend per share 260,000 divided by 10,000. Then per value 10,000, no? Yes, 10,000. Per share dividend value is 26 rupees. That's D0, 26 rupees. Okay. Then here we have to get the D1. Keep in mind. Again, you may doubtful how you get the D0 as 2019 one. Please again be careful. In today we are thinking. Today is 2020. We are thinking of value cost of equity belongs to this particular year. Then D1 is this year. That means D0 is previous year. That's why we got the 2019 one as the D0. Then here total they have paid 260,000 for 10,000 ordinary shares. That's why we divided 260,000 by 10,000 to get this dividend per share. Then D1 we can calculate at 26 into 1 plus G. 1 plus G we calculated 0.1474. Okay. Then divided by P0, it's 75 rupees. 75 plus again G equals to 0.1474. Then you can get the answer for cost of equity. Please take it as a percentage. 2 percentage ya create up the decimal create up here. Please, I think you got the idea. Okay. Right. Now, DJ company has issued 200,000 of ordinary shares 200,000 of ordinary shares at the rate of rupees 10 per share, and the current market price of the share is rupees 12. During this period, company has earned 500,000, out of which rupees 200,000 has paid as dividend. If the ROE ratio is 15%, calculate the cost of ordinary shares. Now you may not having idea at all in this regard, because as we only discuss one method of calculating the growth rate, here we are going to use another equation, another model, that model for calculating G. Here that is known as RB model. At that scenario, G is equals to the RB, where this R known as return on equity, this B is known as retention ratio. I think you may aware of this concept of retention ratio, as you have now studied HNDA program up to the fourth year. Retention ratio. Definitely you may aware about the ROE. When it's become retention ratio, you can calculate it by simply 1 minus dividend payout ratio, 1 minus dividend payout ratio is the retention ratio. Then here we have to identify now again dividend payout ratio to get the retention ratio. Then dividend payout ratio if I am correct, we had a sum like this last in the past paper. Dividend payout ratio equals to, you know that one actually, dividend per share divided by earning per share. I think you may aware about the concept of dividend per share. Then here dividend per share can be how to calculate. Total paid dividends can be divided by number of shares. I will put that one also. Dividend per share equals dividend for ordinary share divided by number of ordinary shares in here. It is total dividends have been paid, out of which 200,000. Then 200,000 rupees divided by number of ordinary shares also, yeah, 200,000. So it's easy. Dividend per share is rupees 1. Dividend per share is, sorry, dividend per share is rupees 1. Then we have to identify earning per share. Earning per share refers to, I think you know, profit after tax minus dividends for preference shares. අපි දන්නවා මොකද්ද බාහිර පාර්ශ්වයන්ට දෙන ගෙවීම් කරලා, the things which we have to pay for outsiders, obligations have to completed, then only those remaining part can be distributed among the ordinary shareholders. Then earning per share can be calculated profit after tax minus dividend for preference shareholders divided by number of ordinary shares. I am not going to deeply discuss these concepts, as you already aware, because you have studied these things throughout last 3 years. Now earning per share can be calculated in here. They have earned profit after tax, let's say 500,000. Okay, 500,000 they have earned, but no dividends according to the given details for preference shareholders. Then answer should be divided by number of ordinary shares. It is rupees 200,000 ordinary shares. Value of which then earning per share is rupees 2.50 rupees. Okay, now you can calculate the dividend payout ratio here. Dividend payout ratio, as we have identified dividend per share is 1 rupee and earning per share is 2.5. Then dividend payout ratio is 1 divided by 2.5, 0.4. Then if dividend payout ratio is 0.4, by adopting this equation, 1 minus dividend payout ratio equals to retention ratio, we can identify that retention ratio is 0.6. 1 minus 0.4. Then we can get the value for G. G equals to RB here. R value already we have been given. ROE as 15%, that means 0.15 into B we identified now 0.6. Okay, then G value is, we calculate 0.6 mm, 0.9. It's 9%. Growth rate is 9%. Here, what we have asked is calculate the ordinary share cost. Then we can adapt the dividend growth model. RE equals to D0 1 plus G divided by, or otherwise D1 divided by P0 plus G then RE equals to rupees 1. Dividend per share is rupees 1 in this particular year. Then rupees 1 into 1 plus G we have identified 0.09 divided by P0. Current market price of a share has been given as 12 plus G 0.09. Then cost of equity is calculated using calculator 0.1808. So it's around, means 18.08%. So dear students, sometimes that this may confuse. Please go through the video 2-3 times when you are to identify the way of getting this retention ratio. Okay. Then that part is over. Now let's move to the paper model, capital assets pricing model. Then here you are going to study this model deeply in next semester under the strategic financial management. So I am not going to discuss this in deeply here, but you should have at least basic idea in this regard. So if you have asked to calculate the cost of capital by giving these data here, KRF means risk-free rate. Normally in financial management, we are thinking that expected rate belongs to the treasury bonds, the securities relates to the government is the risk-free rate, because the getting that return is not having a probability of missing. That means risk is really less. We are assuming that risk of those government securities is 0, and normally we getting the return belongs to that particular securities, treasury bonds, treasury bills, as the risk-free rate of a economic or a market. Okay, and that means in a sometimes you may not have given the value belongs to the risk-free rate, but it can be you the value belongs to the treasury bills as a 0.7% or 8%. Then you should know that is the value belongs to this KRF or risk-free rate. Okay, then KM means market return. Then M minus here again KRF risk-free return. The difference between these two can be known as REM or risk premium. Beta, the concept of beta may discuss deeply under the strategic financial management. So here I am not going to discuss that one purely. Normally, generally keep in mind, it represents the changes, the portion of the market change, the portion of impact. Actually, yeah, I can say it as portion of impacting market changes towards our particular firm. That means if the return of the market changed by market return changed by 10%, how it can be impacted towards the particular firm. That means belongs to beta. The beta calculation you may study it in next semester. Anyhow, in this semester, if you have to answer a question like this, definitely beta value may be given. Okay. Then here you have been given example. If the KRF, that means risk-free rate is 7% and risk premium is 6% and the firm's beta is 1.2, what is the cost of common equity? That means we can adopt this equation K per model. KS equal to KRF plus KM minus KRF beta. Then here you have not given this value, market value, but you have been given the risk premium or 6%. So it is simple. You can use risk-free rate have been given as 0.0707%. You here behalf of Km minus KRF you can put 0.06 market premium value into beta value 1.2. Then answer you can get to the calculator. That's all. Then here it's better refer these things. You have to refer everything, but here it's better. I am suggesting these areas to refer more. You may study these things also. Limitations of dividend growth model. Keep in mind, just try. Just put 0 as the growth rate, then you may not getting any value, market value. Just try it. Some of these things. Just search and try it. Okay, here not having enough time to discuss these things and advantages and disadvantages. Those things you may study and you have to listen. Now we may move to the preference share part. In here, you may have in two types of preference shares as redeemable preference shares and irredeemable preference shares. When it's become redeemable preference shares, after a certain maturity period, the investor may receive, let's say, this particular investor in case of preference shares, this particular investor invest in rupees 100 per share for per preference share for 4 years. That means after the 4 years he should receive this 100 back with dividends. But when it's become irredeemable preference shares, he is not going to have this 100 rupees back, but continuously the investor may receive the dividend, particular dividends for this belongs to this particular irredeemable preference shares. When it's become redeemable preference shares, it can be cost of redeemable preference shares. Normally, it can RP, let's say RPOKP. RPOKP you can use. It can be calculated as D over E0 as dividend valuation method. When it's become irredeemable preference shares, keep in mind here we can identify some cash flows belonging to particular investor. As an example, cash flows. Here 0, this is the year cash flow. If the value of concept should be revised, should be just wait. Erase. Now let's explain. Okay. Now when it's become irredeemable preference share, you can use the equation which we write earlier. RPOKP equals to D divided by P0. But when it's become redeemable preference shares, we can identify some cash flows. Here as an example in this scenario, here 0 we have to investor's point of view. Here 0, no, in company's view, we are going to, let's say we are going to found some funds through the issuing preference shares. Then we can we may receive when investors invest in on preference shares, company will receive, then per share we may receive 100. Then let's say maturity period is 4 years, then 1 to 4 we have to pay, company have to pay dividends, let's say 10 per year up to 4 years. Then end of the period, company has to pay this redeemable value 100. Then there is a cash flow. Then what we need to do, the cost of this redeemable preference shares equals to the IRR value of this cash flow. Okay. Now, I am not going to discuss the way of calculating IRR, but I am going to discuss way of developing this cash flow through these examples. Calculating IRR belongs to you as you have studied now 3 years under HNDA programs. Now let's see this example. It should be example number previous one example. Yeah. Yeah, example number 7. Here, market price of a preference share of ABC company is ₹80 and dividend is paid ₹10 per share. What is the cost of preference share? Then here we have not given any information regarding the redeemability. So we can assume this as irredeemable preference shares. Then we can use simple equation RP equals to D divided by P0, then D equals to ₹10 divided by P0 equals to ₹80. Then answer is 0.125 equals 12.5%. And also here also sometimes as we discussed earlier, cum method can become. Let's say this price P0 is given in cum method Then at that scenario, RP equals to D divided by P0 minus D plus 10 divided by 80. Again here we need to minus 10. Okay, so we can get the value. That's simple. Okay, example number 8. XYZ company issued 10,000 preference shares. Current market price is rupees 9 and dividend paid at rupees 1.1 rupee and 20 cents per share. These should be redeemed by 8 years at the rate of rupees 10 per share. Yeah, redeem value is also there. Compute the cost of these preference shares, redeemable preference shares. Now what we need to do, we have to identify the certain cash flows belongs to these preference shares. At that scenario also you can have two views, from the investor's view or the company view. When it becomes company view, in at the beginning we company receiving the money, then when it become redeeming, company is going to meet that minus cash flow. But from the investor's view, it can be at the beginning when investing it is minus, when redeeming it's positive cash flow. Okay, let's see. Here I am going to adopt company's view. Okay, here first let's develop the cash flows. Here description cash flow. You know how to calculate IRR. I am going to just develop the cash flow. In year 0, company is issuing the preference shares. Issuing preference shares. That means if company issued one preference share, market price is 9. That means company may receive 9 rupees from one particular preference share. Then throughout 8 years, they have to pay dividend 1.2. Then 1 to 8 year paying dividends of 1.2. It's minus because company is paid. Earlier company received. Okay, when it becomes invested view, earlier when issuing preference shares by the company, invested in preference shares, that means 9 becomes 0, 9 becomes minus. Then when dividends receiving, 1.2 becomes plus value. Then 8th year, company has to pay, that means redeem, company has to pay 10 rupee per share. That means company is paying 10. Then using this cash flow, we have to calculate IRR. I hope you may aware about calculating IRR. Here, simply what we need to do, first we have to calculate two NPV values using two discounted factors. Here, let's say if the discounted factor is 12%, then year 0 it is 1. Then here 1 to 8 year, we can get the cumulative discounted factor as 4.968. Then end of the year 8, again normal discounted factor 0.404. So if you not aware about calculating NPVs and the IRRs and these discounted factors, please come up with some additional readings about your AMA notes. Then we can get the discounted cash flows here. 1 into 9, 9 here minus 5.9616, then minus 4.04, then NPV minus 1.0016. Then in calculating IRR, we should have another NPV value under a different discounted factor. So let's say here, what will happen if the discounted factor is 15%? Then here 4.487, 0.327. Then again discounted cash flows 9, here minus 5.3844, here minus 3.27. Then NPV is 0.454. Now you can calculate IRR value. Hope that you know how to calculate IRR. Simply you can use the equation to calculate IRR, or otherwise you can go through the rationale of IRR. In the concept of IRR, I think you may remind that IRR is the discounted factor. IRR is the discounted factor. When NPV becomes 0, then we have to identify the IRR. There are several methods to calculate the IRR value in here. You can simply use equations which you have discussed in the AMA, or otherwise you can use the rationale of the IRR concept. Here, anyway, what you need to do, you have to calculate IRR. Here, now you have got two NPV values. One is 1.0016. Other one at that time discounted factor is 12%. Then next one is positive one, NPV 0.3454. At that time, discounted factor is 15%. Look at here. When discounted factor changed by 3%, NPV value, the difference between these two values is 1.347. NPV has changed by 1.347. Here, IRR means if we graphically represent the NPV value, NPV 0 value will be here. Here minus value, here positive value. It should be middle of these 2 points. Now we are going to identify the value belongs to this point in case of discounted factor. Okay, here IRR. We have identified now 0.12 as our point. Definitely, when in discounted factor is changed by 3%, NPV has changed by 1.347. So, to this point, we can add the difference of the NPV here. Then, simply what we do is 0.12 plus here when discounted factor is changed by 0.03, NPV has changed by 1.347. By dividing the discounted factor change by the NPV value change, we can identify which can be happened if NPV value is changed by 1 unit, 1. Then we can identify what will happen to here if NPV value changed by 0.016, 0.01010, 0.0016. This is the normal equation which we are used to calculate IRR. I just try to explain the rationale of that. Then our IRR value will be 14.23%. That is the cost of this redeemable preference share. Now let's move to the next source, cost of debt capital. When we compare this with the other sources which we discussed, one specialty is there. What is that? The cost, that means interest expense, is tax allowed expense. But when it becomes dividends for preference shares or dividend for ordinary shares, we cannot deduct as expense when we are paying taxes. So this becomes crucial. Okay. Then we have to identify the impact of taxation also. Okay. Then here also, cost of debt capital refers to required rate of return to investors as debtors. Okay. Then that's all, you can read these things. Basically, cost of debt can be also divided into two categories. Cost of debt without having market value, that means which can trade the debt which cannot trade in the financial markets, and debt which can trade in the financial market means with cost of debt which are having the market value. Then as we did in the preference shares, the cost of debt also can be divided, market value also can be divided into two categories as redeemable and irredeemable, which are having maturity period and which are not having maturity period, as like that. Okay. Then let's see these examples. Hurry up. first example 9, that means debt without market value. Okay, here company A issued 500,000 of 12% debenture at the rate of rupees 100 each. These debentures are not registered in a stock exchange. That means no any market value. Tax rate of the company is 40%. Calculate the cost of debt. In these scenarios, simply you can, dear students, you can use simply the equation RD equals to, here keep in mind, K within bracket 1 minus T. Here K means interest expense. K means interest expense. Okay, I will write it again. RD equals K 1 minus T. Here K is interest. Let's see here. K, how to identify? Debenture value is 100. The company have to pay 12% for each. That means 100 into 12%. That means 12 rupees. Then K equals to 12. 1 minus T, here tax rate 0.40%. Then you can identify the value of rupees 72, but as we need it as a percentage, so that means simply for this 100 rupees, the company has to here not 72, 7.2. Company has to incur actually 7.2 as the cost. Okay, that's the summary. After adjusting the, you can identify 12%, but tax impact we can adjust. Then you can identify actual net cost is 7.2. So this also can write as percentage. Our investing value, that means we get 100 rupees as by issuing debenture. Company get, for that 7.2 cost have to incur, then multiple by 100, percentage you can get 7.2%. Okay, this is the way of doing when it's become debt without market value. Now let's see debt with market value, but it is irredeemable. At that scenario, you can use the equation RD equals K within bracket 1 minus T. As this is having a market value, you can put it as P0. It's simple, I think. You know, you are having the idea. Okay, then here K, let's go to the equation. Pays interest of rupees 12, K is the interest, then 12, 1 minus T, that means 1 minus T tax rate 0.33 divided by market price is 90. Then you can get the percentage 0.0893, 8.9. And this is the, then next one, debt with market value and when and also it's redeemable. As in redeemable preference shares, here what you have to do is identify the cash flows and calculate IRR. I will show you, and please do again and again. Okay, then here also you can use to be used as a company or as a creditor. Here I am going to use again company view. here description. Year 0, simply they have issued this debenture, issuing the debenture. Then what will happen to the cash flow? They are going to receive 90 per debenture as market price is 90. Then up to 1 to 10 years, they have to pay interest. Then we have to identify this interest. Here interest per annum is 10, but it is actually not going to put. The reason is tax. Then we have to identify annual interest by 10 is the one which has been given before tax. To adjust it for tax as tax rate has been given as 4%. Then it's 6. Then here interest, net interest they have to pay 6 up to 10 years. Then end of 10 years, when it is going to mature, redeem, they have to pay, company have to pay 100. Okay, then I am not going to do this sum. Use 2 discounted factors at 10% or something, then get the 2 NPV values. 1 NPV, 2, then by using the NPVs, calculate IRR, that is the cost of this. Okay, hope you have got it. Then that's all I think. We have studied so many things in this video. First, we discussed different sources. When it's become ordinary shares, we discussed 3 main methods. Okay, first one is dividend valuation method. Then dividend growth model. Then paper model. Then we discussed about preference shares. Under preference shares, we discussed the way of calculating redeemable and irredeemable. Okay. Then we discussed about debentures. Under that, with market value and without market value. Then when it's become with market value debentures, again we discuss redeemable and irredeemable. That's all. Now, by using this example, you can calculate this example shows the way of calculating weighted average as we did in very first slide, the slide I did some. I will show here the way. What you need to do is each and so every sources you have to calculate the cost as we discussed up to now. Then you can get these values. In exam, you may not given these values. Okay, you have to calculate these values by adapting. As an example, when it become KE, cost of ordinary shares, or KS, you have to adapt dividend valuation model or dividend growth model or CAPM model. You have to get this value. Preference shares also, when it can be redeemable, irredeemable, you have to identify the situation and calculate this value. Then you can calculate weighted average cost of capital thing. Okay, let's see in this example. We are having this free capital sources. I will. Sources as ordinary shares, preference shares, and debt. Okay. Then cost of those also have been given. Ordinary shares 18%, then 15%, 12%. Then you have to identify the way. It can be, keep in mind, based on the sum it depends. It can be on weighting can be done on book value or market value. In the sum it can be given, or otherwise based on the assumptions you have to do that. Okay. Then here we have not given the market value, so we can use the this book value. Okay. Then we can have total requirement, total book value is 100 plus 50 plus 350, 500. Then weight belongs to the ordinary shares equals weight belongs to the ordinary shares equals 100 over 500 PNCR. Then weight belongs to the preference shares 50 over 500. Weight belongs to the debenture 350 over 500. So here it's ordinary shares, it's around 20%. For preference shares, it's around 10%. For debentures, it's around 7%. Now what you have to do is you can calculate weighted average cost of capital. Here, first column should multiply by second column. This into this, you can put these values. Okay. Okay. 1 into 2. Okay. Then you can get the final total. That is the weighted average cost of capital belongs to this scenario. So actually this sum is not, dear students, here within this time period I just tried to cover up the basics of this syllabus. So it's better go through the past papers. It's better go through, especially with the books of AAT and the Chartered and CMA. Go through those sums. You can get lots of knowledge based on this basic understanding about these scenarios. I also most of these sums got from the professional courses guidebooks. So hope you have got something to session and use this time period and try to study. Thank you. Then if you have any doubts, it's better contact your department. And if you want any more support from me, I hope to put another session on dividend valuation also. On that, let's meet, as I am going to discuss the part of evaluation of long-term finance. Okay, good luck.